I believe that the precious metals bull market that we are enjoying today has a substantial amount of time left to it. And it doesn't merely go higher, it goes substantially higher. I would caution all of you who get excited about day-to-day moves that you could have very substantial down moves or very substantial up moves that really have nothing to do with the underlying bull market. But I think it is probably coming to be time for silver to pick up the pace. We've discussed at the Real Classroom many times the fact that precious metals bull markets are led by gold. The fear buyer always comes before the greed buyer. When the narrative is established by gold and the generalist investor starts coming down into the space, silver, perhaps because of its lower unit value, picks up the pace and begins to outperform gold. Silver has been a laggard relative to gold, and it might be that people are figuring that out. I would caution people uh, listening to this discussion today to not be too focused on the day by day. If I've noticed any mistakes that speculators make as a consequence of grading tens of thousands of portfolios, it's that people's time preference gets in the way of their investment performance. I believe that the precious metals bull market that we are enjoying today has a substantial amount of time left to it. And it doesn't merely go higher, it goes substantially higher. Whether or not leadership transitions from gold to silver today or a year and a half from now are probably less relevant. What's more relevant to you is patience and position sizing. I would caution all of you who get excited about day-to-day moves that you could have very substantial down moves or very substantial up moves that really have nothing to do with the underlying bull market. I am reminded of my own entrance into the space in the 1970s and the fact that in 1975, when interest rates were allowed to rise or forced to rise, pardon me, that the price of gold fell by 50% in 1 year. That shook out a lot of the so-called faithful, and those who did get shaken out missed a move when gold resumed its upward trend from a low of $100 an ounce in 1975 to $850 an ounce. The point of all this is, while it's fine to get excited or frustrated or whatever uh, on day-to-day moves, it's much more important that you pay attention to the fundamentals and the trends that are more likely than not to occur. Stay the trade in precious metals. Don't get yourself too excited one way or another day by day. Congratulations to the silver bugs. Who knows whether there's any follow through in the near term? I'm almost certain that there'll be follow through in the long term. I hope that helps, Albert. One of the things that really amuses me today is the increasingly personal nature of the dispute between our president and his former erstwhile colleague, Elon Musk. Uh, since Musk started describing Mr. Trump's quote, big, beautiful bill as a big, ugly bill, and pointed out that while the spending was current, the budget cuts were promised. In other words, pointing out that the bill, in terms of being about smaller government, was a fraud. Mr. Trump's rebuttals have been increasingly verbose. And amusingly, to me at least, the dispute got personal today. Musk just said a couple hours ago that the real reason that the Epstein file names haven't been released is because Mr. Trump is on it. Mr. Trump didn't think that was very funny. And so it would seem that what was until a day ago a policy dispute has become a personal dispute. Well, nothing really that I can think of could make me happier than a bunch of high profile politicians fighting with each other so they can leave me alone. I think the spat and the issues around the spat are likely to continue to polarize American politics. and likely to cause more turmoil in equity markets and debt markets. With regards to the bill, I agree with Mr. Musk. I don't think his criticism, frankly, went far enough. Uh, Over 1,000 pages of hidden spending, hidden subsidies, all kinds of transactional uh, gobbledygook. This had nothing to do with making America great or making America's government smaller. This was a traditional transactional bill in the best sort of tradition of both the Democrats and the Republicans. That's how we got ourselves in the condition that we're in today. The dispute around the bill masks a bigger problem, which is to say our ongoing debt and deficits and our ability to sustain the level of government and the level of government services that we, quote, enjoy today. Which is to say the reckoning, is something that is to come in the future, and I'll talk about that in a minute. But the dispute, the polarization, is something that is likely to inflame all kinds of people's emotions, big and little. And inflamed emotions are all about what market volatility is about. So my gut tells me that the next 6 or so weeks should be more volatile than usual. If you have the personality like myself, where volatility can be used to your benefit, which is to say, if volatility results in rapid share price declines that you are inclined to buy, or if it results in rapid share price increases that you're inclined to sell, this volatility can be a very good thing. If, however, you know yourself to be a person who is more easily influenced by your emotions, you're going to have a very difficult time, I would suggest, in the next 6 weeks, because stuff is going to be, up and down. There's going to be all kinds of wild prognostications. You're going to have to be very careful that your emotions don't get in the way of your portfolio. Looking forward, I think the impact of this bill, whether it passes or not, what a subsequent, if any, bill looks like, the trend is very clear. We've talked before at the Rule Classroom about the fact that the net present value of off balance sheet obligations facing the US government exceeds $100 trillion, while the on balance sheet obligations owed to bondholders exceed net $30 trillion. We've talked too about the fact that the accretion of liabilities, both on balance sheet and off balance sheet liabilities, is proceeding at about $4 trillion a year. This is unsustainable, as is a political correction to this unsustainable trend. It is my personal belief, and I'd like you to think about it as opposed to believe it because I believe it to be true. My personal belief is that the end result of these unfundable political promises that we can't politically renege on is that the purchasing power of the US dollar in the next 10 years will fall by approximately 75%, very similar to the 75% decline that we faced in the US dollar, in the purchasing power of the US dollar in the period 1970 to 1980. Is this a certainty? Absolutely no. Other things could happen. Is this a contingency worth insuring on? Absolutely. And how does one insure? Well, precious metals. And if you're willing to do the work, precious metals equities is one way. As we've discussed before in the Rule Classroom, the volatility in this asset class during a bull market is extraordinary. 200%, 300%, 400%, 500% moves are commonplace. So it doesn't take an outsized portfolio allocation in precious metals and precious metals equities to shield the rest of your portfolio from the impacts of a 75% devaluation in the purchasing power of the US dollar. I want to clear something up too. I've noticed in the comments a suggestion that this decline in the US dollar was relative, which is to say declining against other currencies. I think the US dollar will likely outperform many currencies, despite the fact that the purchasing power of the US dollar in US dollar terms, in absolute terms, falls by 75%. Some other currencies likely fall even more. So While I understand that you need to maintain liquidity, at least some of you do in a variety of currencies, understand that my discussion of the decline in the purchasing power of the US dollar relates to US dollar uh, domiciled portfolios. In other words, it isn't relative to the Canadian dollar or to the euro or to the pound or anything like that. It's a decline in absolute terms.